In this lesson, we will discuss value investing, but we will take a slightly different approach than other value investing classes to make it a bit more interesting. We will keep storytelling to a minimum and focus on bringing facts and figures. So, first off, why do we care? We care because value investing is a proven way to beat the market and generate outsized returns. In this lesson, we will learn what is value investing. We will see how value investing has performed over the last several decades. We will discuss why value investing works so well and how you can apply value investing, even if you're not a professional money manager and do not have the capacity to perform deep fundamental analysis on your stocks. It seems that every investor today is a value investor. The term value investor has lost its uniqueness. Who wouldn't say that he or she aims to buy a stock at a price lower than its value? The gamut of value investing is so wide. Carl Icahn, you see in the picture in the left, calls himself a value investor, and he's an activist shaking up boards. Bill Ackman refers to himself as a value investor, and he is famous for his short positions. Warren Buffett, well, I don't need to introduce him. Walter Schloss, deep value junk stocks. Wesley Gray, quantitative strategies. And Monish Babrai, concentrated high quality compounders. The gamut of value investors and value investing methods is so wide, yet all are united by Benjamin Graham's simple notion that price and value are distinct quantities, and that where the two are sufficiently far apart to provide a margin of safety, an opportunity exists to invest. So, what is value investing? Let's go back to the father of value investing, Benjamin Graham, and see what he had to say about value investing. Graham said that value and price are two distinct entities and that they can be far apart from each other. In his book, The Intelligent Investor, he had written, a stock is not just the ticker symbol or an electronic blip. It is an ownership interest in the actual business with an underlying value that does not depend on its share price. And when the price of a stock is sufficiently lower than its underlying value, an opportunity exists to invest. Graham called the difference between value and price the margin of safety. The larger the difference is, when of course the price is lower than value, so it is safer to buy the stock, as the margin of safety is larger. Graham had said, and you can read it in the second quote here on this slide, that the market is not a weighing machine which measures the inherent value of a stock, but rather a voting machine which shows what individuals which comprise of the market think about a stock, think about the stock value in any given moment. And that market consensus may be disparate from the real economic intrinsic value of a company. Now, the last element is eventually that price catches up with value. And when that happens, you earn from closing the gap between the low price that you had paid and the new price, which now equals to your perceived value of the company. There's an interesting anecdote about Benjamin Graham which shows what exactly Graham thought of the mechanism where price catches up with value. In 1955, Graham was summoned to a congressional hearing to discuss the mechanisms of the market and Wall Street practices. The market has just returned to 1921 prices, and the Senate committee wanted to understand how to prevent another major meltdown like the 1929 one. Graham was asked, why does price catches up with value? And he responded, that is one of the mysteries of our business. And it is a mystery to me as well as to everybody else. We know from experience that eventually the market catches up with value. It is realized in one way or another. Let's try to summarize the principles or maxims that Graham articulated on value investing. First, you need to be an investor, not a speculator. We covered investment versus speculations elaborately in the previous lesson. If you haven't watched it yet, go ahead and do that. Secondly, know the asking price. You have to make your mind whether that asking price is a steal, a reasonable price, or maybe overpriced. Thirdly, rake the market for bargains. Markets make mistakes. You see, Graham wasn't a big supporter of the efficient market theory. He definitely thought that prices can be much different than intrinsic economic values. And if you find those mistakes, you can make outsized returns. But for that, you have to be disciplined and buy cheap. And this is his fourth principle. Next, he was suspicious of reported corporate figures. He knew that corporations and managers had incentives to make financial results look prettier because the corporation, its owners, and its managers usually were able to profit from showing better financial results. Graham advocating looking at financial results critically, with suspicion. The next principle that Graham was teaching is diversification. This is only debated, this is often debated among value investors. The school of thought of Warren Buffett and Charlie Munger advocate holding just a handful of stocks, concentrating, rather than diversifying. Charlie Munger even said once that you need to hold only 4 stocks. That's the level of the diversification that you need. But then, ultra low priced stocks have much lower quality than stocks that Buffett and Munger used to own. When you buy ultra low priced, low quality stocks, you must diversify heavily because you cannot anticipate if any specific stock will revert to the mean and go up or continue to deteriorate and eventually go bust. Lastly, you have to be patient because often the difference between price and value takes time to close. Undervalued stocks can stay undervalued for quite a while, and you cannot know when price will catch up with value. So we've seen earlier that there are many value investors operating in many different ways, yet all are regarded as value investors. Now let's try to generalize and look at 3 categories of value investors. And I'm relying here on definitions made by Aswath Damodaran, who is an NYU, New York University, Stern School of Business professor. The first category is passive screeners. This is actually our approach in taldavidson.com. Quant value investors fall into that category. Basically, we screen for stocks with characteristics that historically correlated with overperforming the market. Those characteristics are selected because they make economic sense. The characteristics are often called stock factors or smart beta factors. Example for those are low valuation multiples, low beta, small stocks, high quality of earnings and financial stability, high momentum, and many others. We rely on the propensity, on the increased chance of stocks with such characteristics to outperform. We are not looking for profits from any specific stock. Rather, we want to earn from the phenomenon, from the group, from the aggregate of stocks with such characteristics. So passive screeners, they must diversify broadly. The second group of value investors are contrarian investors. Most famous value investors fall into that category. They are investors who invest in companies that others have given up on, either because they have done badly in the past or because their future prospects look bleak. Such investors research individual stocks in depth. They are very selective and therefore they cannot diversify very broadly. The last group I want to mention is activist value investors. Now, Carl Icahn, David Einhorn, and Bill Ackman fall into that category. These are investors which buy a large stake in poorly managed companies and then engage with the board of directors, either in a nice way or in a hostile manner, to change the way that the companies operate. Either replace the current management or restructure the company financials or change the company strategies or everything altogether. Well, all of this is nice theory, but then how does it stack up to reality? Does value investing really outperform the market? Does it outperform the opposite side of the scale, growth investing? Let's look at the data now. The data that we are showing here was taken from a really good book, which I recommend, called Do It Yourself Investor, written by Wesley Gray. Gray compiled a table from data collected by another well-regarded researcher, Nobel laureate Eugene Fama, who he makes this information public on his website. The table shows, you see here, that over a period of 87 years, from 1927 to 2014, 87 years, value firms earned on average 12.4% per year versus 9.95% for the S&P 500, and then only 8.68% per year for growth firms. You can also see from the table here that value firms were more volatile, as can be seen by looking at the standard deviation figure. Clearly, value investing wins over time. I think it's evident. In my website, taldavidson.com, I publish the results of my own research on value investing strategies. I tested those strategies in a simulation spanning only 18 years, from 1999 to 2017, because this is the data I have. But I think that those 18 years give a good enough indication if a certain strategy is beating the market over time or not. The first results I want to show are for a very well-known strategy, one that has been around for 70 years since Benjamin Graham published it in his 1949 book, The Intelligent Investor. It is called Selection Criteria for the Defensive Investor. It buys profitable companies with low valuation multiples. It is very, very simple strategy, and literally everyone can implement it on their own. If you're interested in additional details on how to implement it, go to taldavidson.com. This simple strategy earned 11.48% per year on average versus a market return of 5.2%, including dividends. That is twice the market return on that period. And it was achieved with about the same volatility level of the market. Just to illustrate, a portfolio based on this strategy earned 600%, as you can see here, over those 18 years, whereas the S&P 500 earned only 146 years over the same period. Naturally, all numbers are before taxes. Let's look at another strategy I write about and make available in taldavidson.com. This strategy is called Quantitative Value, and it buys the highest quality stocks out of a bucket of very cheap stocks. This strategy delivered 24.8% a year on average between 1999 and 2017, same period. It resulted in an overall return of more than 5,000%. over those 18 years. Yet I must indicate that it has achieved this magnificent return with quite a bit of volatility. Value investors, and particularly quantitative value investors, should acknowledge that strategies that deliver high returns are often very jittery, very volatile. To achieve a great gain, you must survive the volatility pain. In the short run, your profits may suffer large drawdowns, but in the long run, they will outperform. One of my favorite strategies is one I call systematic, safe, and cheap. It buys stocks which are cheap compared to the average industry valuation on which they operate. The strategy is different in that respect from other famous quantitative strategies. Most quantitative strategies, including those I have on my website, search for stocks with low absolute valuations, asserting that those stocks are cheaper on average than their intrinsic values. But systematic, safe, and cheap searches for stocks which valuation is low relative to the average valuation of stocks in their industries. It's relative rather than absolute. The strategy buys safe companies, those that have a history of good profitability, even if they are currently unprofitable. In a simulation, that the one that I'm showing here, the strategy had made only 20% a year, but it is far less volatile than quantitative value and deep value, which I'll show next. I plan to offer the opportunity to invest in these strategies through managed accounts once I complete the process of becoming a United States registered investment advisor. The last strategies I want to show is a deep value strategy. In this simulation example, the strategy delivers 23% per year on average. And let's talk about what is deep value and how it is different from other forms of value investing. With deep value, we are screening for the cheapest stocks in the universe. Not cheap stocks with high quality, and not even with mediocre quality. Cheap stocks, period. Deep value buys the ultimate cheapest stocks in the universe without any regard for their quality. So naturally, most of these stocks are those of troubled companies, ones with losses, incapable management, business risks, and many other problems. Yet when you buy a large bucket of those second and third grade companies at a very low price, as a group, they will outperform. You see, the valuation of those companies is so depressed, and the forces working to make those companies better are so powerful that on average, these stocks will return at least to being just mediocre. And with that, they will close the gap between price and value, resulting in outsized profits. It is very hard intellectually and emotionally to hold such troubled companies, and that creates the opportunity. Those who are willing to invest in those companies are left to make a nice profit. It's easier to invest in deep value stocks quantitatively. A rule based system helps you control your emotions and be invested through the volatile path until the alpha of the portfolio is realized. So, now to the interesting question: why does value investing works so well? Well, there are two concepts that come into play. The first one is limits to the efficient market. The second one is limits to arbitrage. Let's start with the first, limits to the efficient market. The efficient market hypothesis, or EMH, was articulated by Professor Eugene Fama, which we discussed earlier, and Professor Kenneth French. It claims that asset prices fully reflect all available information. A direct implication is it is impossible to beat the market consistently on a risk adjusted basis, since market prices should only react to new information. Fama argued that stocks always trade at fair value, making it impossible for investors to either purchase an undervalued stocks or sell stocks for inflated prices. As such, it should be impossible to outperform the overall market through expert stock selection or market timing, and that the only way an investor can possibly obtain higher returns is by chance, luck, or by purchasing riskier investments. Sorry. This all sounds very logical, but it fails to explain why many investors, especially the students and followers of Benjamin Graham, were able to beat the market consistently over so many decades. The evidence and facts show that the EMH is limited. Warren Buffett made a very interesting speech on that, which he called The Super Investors of Graham and Doddsville. I'll have the link up in the lesson page. In it, he says that coincidentally, or not coincidentally, all those super investors that beat the market over decades belong to the same school of thought, an intellectual village, which he calls Graham and Doddsville, after Ben Graham and his security book co-author, Professor David Dodd. It is highly improbable that so many super investors thinking alike were just lucky. The most accepted explanation on why cheap stocks outperform is that most investors overreact to bad news. Institutional investors have a hard time explaining to their clients and also to their peers why they hold losers. And this drives many of them to sell failing stocks at any given price, even if this price is cheap. In addition, many investors fall into a cognitive bias, fearing that declining stocks will continue declining for years to come, while the evidence shows that on average, the farther a stock underperforms, it is more likely to correct and revert to the industry mean. In value investing, we buy losers today because they are so cheap, and we sell them later when the losers become mediocre and their price becomes not cheap at all. What I just told you, it's no secret. Everybody knows it. So how come the opportunity still exists? After all, we are not the only smart investors operating in the stock market, aren't we? How come the opportunity doesn't evaporate just because there are so many smart people who try to exploit it? Well, here comes the second concept called limits to arbitrage. The concept claims that value strategies, as well as momentum strategies, can underperform the market for protracted periods of time, even 3 to 5 years. So what would you do if you employed a money manager who is lagging the market for 1 year, then 2 years, and then 3 years in a row? Most likely, you will fire him or her. Even if this manager had perfect foresight into which stocks will earn the maximum returns. Because the road is so rocky and volatile, the manager wouldn't survive. And this is the exact reason why most money managers hunt for short-term gains rather than long-term outperformance. And it is also the exact reason why most retail investors lag the market over the long term. They simply do not have the patience to live through the volatility and thus to be able to outperform in the long term. Value investing works in the long term because it doesn't always work in the short term. Before we end this lesson, I want to mention how the value investing strategies that we have on taldavidson.com are different from other strategies you may find elsewhere. So, first, we rely on hard facts, not notions. Our models are based on data driven academic research spanning more than 25 years. Secondly, as you know by now, we run rule based systematic portfolios. We keep it simple long only portfolios, no over the counter stocks, no shorting, no margin, no options, no financial engineering, no complications. We invest for the long term, accepting short term underperformance. And I eat my own cooking. My net worth, my life saving are invested alongside the strategies. Our motto is it works in the long term because it doesn't always work in the short term. So let's recap. Value investing is a method for investing in stocks with prices which are sufficiently lower than the intrinsic values of the underlying companies. Value investing beats the market in the long run, although it may lag the market in the short run. Value investing is likely to continue outperforming in the long run, as long as most investors will continue chasing short term profits. There are many ways to beat the market through value investing. You better choose a system and stick with it. In taldavidson.com, we prefer quantitative value investing as it helps us control our emotions and cope with the inevitable volatility. And with that, we end this lesson. See you all in the next lesson. And until then, happy investing.